Hi, this is Michael O'Leary from Buy the Book Taxes, here with our weekly video blog talking about how the IRS determines how much a taxpayer can afford to repay their tax debts. Over the past few weeks, we've been talking about a concept called reasonable collection potential, which has three variables: net equity and assets, future income, and allowable living expenses. The last two video blogs we had were on net equity and assets and the allowable living expenses. Today we're going to talk about future income. Future income is a cash flow measure that looks at all sources of cash that come into a household in a given month. It's called future income. I kind of like the idea of future cash better because it's not just your take-home pay from employment, but it has other components too, and we'll talk about those. Here's some of them. Future income is made up of W-2 income, net business income from self-employment, rental income in case you own investment rental properties, Social Security, pension, retirement income, investment income, interest, dividends, capital gains, alimony, child support, and any other source of cash that comes into your house. I want to give credit. This page, this chart, comes from a book called The Accountant's Guide to Resolving Tax Debts, written by an attorney in Connecticut named Eric Green, and I believe it's on page 23. I just want to give credit where credit's due. Okay, so in determining how much a taxpayer can repay, the calculation is this: net equity and assets plus monthly future income less monthly living expenses per month for the amount of months left on the collection statute. Here's an example. Let's say you owe $20,000 for tax year 2015. You filed your return on April 1 of 2016. The IRS has they have 10 years until March 31st of 2026 to collect that debt. So let's say you have $5,000 of net asset equity and $500 per month left over after doing the calculation of future income less your allowable living expenses. The question is, can this taxpayer afford to pay back $20,000 to the IRS, assuming now it's the end of February 2019, basically in the next 7 years? And the answer is yes. If you take the $20,000 divided by 84 months, add some interest and penalties, the taxpayer could pay back that balance by March 21st of 2026 with about $250 or so per month. So you would put them on an installment payment agreement. The IRS will not compromise when there is enough income and assets to pay the balance due within the statutory period they have to collect it. What happens if that's not true? What happens if the calculation of net equity and assets minus future income less allowable living expenses does not generate enough to pay by the statutory collection date. Then you should have your tax professional look at either a partial payment agreement or an offer in compromise, or really if there are no assets and no funds left over after living expenses, the client might be considered currently not collectible. But these items will be the subject of blogs over the next several weeks, so please stay tuned. If you have years of unfiled tax returns or unresolved tax debts and you need help and you're getting letters from the IRS or a state, please contact me. I can help. See you next week.